So we talked then about investing. We're going to stay in the market. We're not going to try to time the market. We're going to be in the market. Then the question is, what are the actual brass tacks of investing? So how do we actually invest? And this is where we get into the concept of asset classes. Okay. There are out there lots and lots and lots of potential things you can invest in. Lots of different companies, both American and international, big and small, lots of different bonds. There's loads of opportunities. It's overwhelming. So, to simplify this in personal finance, we talk about the idea of an asset class. And an asset class simply refers to a category. Okay, when we talk about asset classes, we're talking about a category. Asset classes are categories of investments that share similar characteristics. So, an asset class is a category of investment that shares similar characteristics. And in personal finance and in investing, we tend to break, there's a lot of different assets out there, but we tend to focus on the big three. And when it comes to investing, we focus on cash, stocks, and bonds. Okay, those are the big three asset classes. Now, there's a couple of really important things here that are going on. Let's talk about them. Number one, cash we know is cash. So cash is great. If we, for the moment, ignore the effects of inflation, we know that cash is not only liquid, but it will, and again, we're ignoring the inflation effects for the moment, cash will hold its value. I mean, if you have $100 bill, it'll still be $100 bill in a year and in 5 years. So it doesn't have the up and down volatility that other assets have. On the other hand, while cash is liquid and fairly stable, it does not grow. And remember, the purpose of investing is to grow our money. So cash is okay, but it's probably not going to be a big part of your mix of assets. On the other hand, if you want growth, now we're talking about stocks. Because when you own a stock, you own a piece of a company. Stock is about ownership. Imagine Tesla. Let's just take any company, Tesla. You buy a share of Tesla stock. When you buy a share of Tesla stock, you are a part owner, maybe a tiny minuscule, but a part owner of that company. And as an owner of the company, you have the legal right to a future share of the company's profits and cash flow. So stocks represent ownership in companies. When you buy a stock, you're participating in the economy as an owner, and you're entitled to the future share of profits and cash flow. This is very good. But along with that comes risk. Because, okay, so stocks are your ownership, and over time, stocks grow very, very rapidly. You can think of your investments, think of your overall asset mix as a rocket. Stocks are like the engines. They're the thrusters. They lift that rocket up. They propel your portfolio. They're also slightly risky and volatile. Okay. And that's where bonds come in. Because whereas stocks represent ownership in a company, with the stock, you're participating in the economy as an owner. In the world of bonds, you're participating as a lender because you can think of bonds as being debt. In other words, when you buy a stock, you buy a little bit of ownership in a company. When you buy a bond, you're participating in the economy as a lender because bonds are effectively debt. They're IOUs. Let's go back to Tesla. Tesla decides that they want to build a new factory and they want to borrow money. They use bonds to do that. And when you buy a bond, let's say you buy a $1,000 Tesla bond, you are loaning Tesla that $1,000. You're loaning to them for a predetermined term. That's called the term or the maturity of the bond. And what Tesla promises in return for that loan from you, they promise, number one, to pay you interest every 6 months. And then eventually, after the term, they promise to pay back your initial loan. So with the stock, you own the company. With a bond, you lend them money. And with the bond, the company says, hey, we promise to give you some interest and we promise to pay you back the money at the end of the term. Now, stocks are a lot safer. Sorry, forgive me. Bonds are a lot safer than stocks. So they're less risky. You can think, if we thought about stocks as our growth engines, we can think about bonds as our stabilizers. If our assets, if our investments are rockets, stocks are the propulsion. Investments are stocks are the propulsion, bonds are the stabilizers. They give us balance, they reduce volatility. Okay. Therefore, they are less risky. Together, the collection of cash and stocks and bonds, this is what we call your portfolio. Your portfolio is just a fancy term for all the assets that you own. And another important term is asset allocation. Okay. If you think about all of your assets as being like a pie, the size of each pie, the size of each slice, let's say cash is this slice and stocks are this slice and bonds are that slice, the size of each slice is your asset allocation. So the portfolio is what you own, and the asset allocation refers to the proportionate share of each of these categories as a share of your overall holdings. And this is really important because we said that stocks were a little bit more risky, but they give a little bit more growth. And we said that bonds are a little less risky and therefore they give less growth. Well, you can see that the different sizes of the pie slices, you can see that the proportional weights of your asset allocation is going to be a big determinant of whether your portfolio is more conservative or more risky. Because the relative weight of stock and bond and cash that you have, the relative size of those three slices of pie, that's going to tell you if you're more risky or more conservative. Stocks are riskier. So a portfolio that is heavy stock and light bond is probably going to grow more over time, but it's going to be a lot riskier, a lot more volatile. On the other hand, conservative investors might say, hey, listen, I want some stability. So they're going to go a little bit heavier bond and a little bit lighter stock. Okay. So that basic idea of asset allocation is really important when it comes to determining your risk. There's a few rules, not rules, I should say rules of thumb. And one of the rules of thumb, and there's many, is the rule of 110. The rule of 110 says that if you take the number 110 and subtract your age, that could be the proportion of your portfolio held in stocks. You can see that with the rule of 110, the suggestion is that when you're younger, like you all, when you have more time ahead of you to offset risk, when you have more time ahead of you to recover from market volatility, you take a riskier position. And then as you get a little older and a little older and a little older and a little closer to your retirement, and your window of time gets less and less and less, you go to a much more conservative bond heavy portfolio. Okay. So that's the idea of risk. One thing that's very important is what we call the risk return trade off. And it basically says that in personal finance, if you want higher returns, you have to take more risk. And it says that if you don't want as much risk, that's cool too, but you're going to get less return. Okay. There's a direct relationship, we believe, in financial markets between risk and return. And we call this the risk return trade-off. Okay. The final key thing around this, let's now move down to sources of return. So we talked about the risk. The next question comes in. We say that assets generate returns. Where does it come from? And there's basically two broad categories of return. The first broad category is the cash income that your asset generates. Okay. All the assets that you can buy, stocks and bonds, especially maybe rental property, they generate cash income. Okay. Cash income refers to the amount of cash that is actually generated by an investment. So, for example, stocks will pay out dividends and bonds will pay out interest. And if you own rental property, they'll pay you monthly rental income. Okay, so that's cash income. That's the first source of investment return. The second source of investment return is what we call appreciation. And this means that your asset goes up in value. You know, if Tesla, you buy that Tesla stock and Tesla's doing really well, you might say, wow, this company's doing great. And other people might want to buy that Tesla stock from you to own that little piece of Tesla. So maybe you can sell the stock to them at a higher price than you bought it. That's called appreciation, which is also known as a capital gain. So all investments generate return either through cash income payouts or through appreciation in the value. So we can say that returns equal cash income plus appreciation. Okay. And this leads us to a really important idea, and that's called ROI. When we say that an investment went up by 8% or that your investment grew by a certain number, we're talking about the idea of ROI. ROI stands for return on investment. ROI stands for return on investment. This is equal to the profit that you earn divided by the amount of your original investment. It's always measured as a percentage. So your return on investment, your ROI, that is the profit that you earn. Okay, it's these two here, divided by how much you paid. Okay, all return can be thought of as what you get out based on what you paid in. Okay, that's ROI. So let's do a little simple example here. If you invest $100 and you earn a profit of 15, we would say, okay, well, 15 divided by 100, that's going to be a 15% ROI. Okay, we can do that way. We might also go backwards. We can say, oh, okay, I invested $4,000 and I really want to get a 17.5% return. Well, we can say that your ROI is equal to your profit divided by your investment. And we can work back and say, well, that means that 17.5% has to be equal to your profit divided by 4,000. And you can plug those numbers in and you can see that you would have to earn a $700 profit. And then we can go back to our basic one. Let's get rid of these right here. And we can say that if you earn 3,500 on 11,000, your ROI is going to be 0.318 equals 31.8%. Okay, so that's the return on investment. Do a little sample here. Joe purchased 100 shares of stock for 20 a share. During the year, he received dividends totaling 150 per share, not too bad. And at the end of the year, the stock was sold for 32. So you would say, what is Joe's profit? What did he earn? Well, we can just break it down and say, okay, he had 100 shares, and each of those shares generated a buck 50, $1.50 in dividend. So he earned a total of 150 in dividend. At the end of the year, each share was $32. So it was $32 per share minus the 20 that he paid. So that's a gain of $12 per share, and he bought 100 shares. So he also pulled $1,200 in appreciation. So 150 in dividends, 1,200 in appreciation. And you can say that he bought 100 and it cost him 20 per share. So he spent 2,000. So you could do the math and say, okay, his ROI is equal to his profit divided by his investment. And you enter those numbers in, that's going to be 150 plus 1,200 divided by the 2,000 that he paid. And you can figure out those numbers and solve that. Okay. So that's risk, return, asset class, allocation, conservatism, or riskiness in your portfolio. All these big ideas, but we can kind of narrow them down to a few. The last part of this lecture that I want to address is the idea of time. Okay, we've talked before about TVM, time value of money, and we've talked before about the power of compound interest. At this point, I think just as a broad principle, it's essential that you understand the importance of starting to invest early. Okay, we've talked before in this class about the ideas of control, about focusing on what's in your control. The reality is, my friends, you cannot control interest rates. We cannot control the stock market return. We just have to accept what we're given. But what can you control? You can control when you start. In other words, of all of our different variables on the financial calculator, you can control your N, because the quicker you start, the sooner you start, I should say, the more time you're in the market. The more time you're in the market, the bigger your N is. The bigger your N is, the more money your initial investments will grow to. And I want to just show you, you don't have to solve anything, but look at these shocking numbers. Instead, a quick example. There's 3 investors. Each decides to invest $1,000 per month, so $12,000 per year. They invested into a fund with a 7% rate of return. So they're going to each invest $1,000 per month. They're going to earn 7%. We're going to go 2 ways. Check this out. We're going to say, what is the final outcome at age 65? If one of the investors started investing at age 25, one waited 10 years and started investing at age 35, and one waited 20 years. Okay, so we're going to say that Abe started investing at age 25, Bernadette at 35, and Candace at 45. Okay. If they were to each invest, well, you can see, first of all, that Abe was in the market for 40 years, Bernadette for 30, and Candace for 20. Because again, Abe started at 25 and was in until 65. And Bernadette started at 35, was in until 65, and Candace came into the game late. Okay. You can see that if you took the $12,000 per year multiplied by the number of years, Abe originally invested $480,000, Bernadette $360,000, Candace $40,000. So all of these are important numbers too. But take a look. This is the key. Look at this. At the age of 65, Abe would have 2.6 million. Bernadette would have 1.2 million. Candace would have 520,000. Now you might be saying, well, Eric, that doesn't really do much because obviously Abe's going to have a lot more money because Abe was investing for 40 years. You're right. So now look at case number two. So in the first case, we assumed that once they began investing, they just kept on going. But let's do a little variation here. In our second case, let's assume that these three investors invested for only 10 years. And then after 10 years, they stopped contributing and they let the money roll. So in other words, Abe starts at age 25, goes until age 35, invests for 10 years. Bernadette starts at age 35, invests until 45 for 10 years. Candace starts at 45, late to the game, goes till 55, in for 10 years. You will see that each of these investors being in for 10 years contributed the exact same amount, 120,000. Now we're going to assume that once they invested for 10 years, they stopped putting money in and just let the money go on cruise control until retirement. So Abe, at the end of the 10 years of investing, each investor would have $173,085. So you think, okay, they made the same amount of money. But now check this out. Abe started at 25, went until 35, earned this much money, and then let it roll for 30 years. Bernadette started at 35, went until 45, had this much money, let it roll for 20 years. Candace came late to the game, started at 45, was in for 10 years. At the end of that 10, had 173,085, and then let that roll for 10 years until age 65. So again, to make it really clear, each of these three invested for only 10 years, earning a total in those 10 years of 173,085, and then just letting that amount ride on cruise control until they retired. Abe let it ride for 30 years, Bernadette for 20, Candace for 10. And look at this down here. Massive differences. Abe ends with 1.4 million, Bernadette with just shy of 700, and Candace with a lowly 347,000. What's this tell us? It tells us that time is important. Time is important. The longer you're in the game, whether you're actively investing every month, not actively, whether you're investing money every month or you're just letting earlier money carry, the longer you're in the game, the more you're going to make. Again, each investor only invested 120,000 total. Yet look at the growth. And the key here was all about time and the power of time in the market. Okay? So that's the principles of investing. We know that we're going to have asset classes. We know that there is going to be some risk. We know that time in the market's great. Here's the question that we're going to end with. How do we do it? What tools can we use? And the answer that we're going to learn in the next lecture is we're going to learn about index funds. And we're going to think about index funds as the main tool of our retirement. We'll continue that lecture, and I'll see you in a bit.